Investing in the stock market is one of the most effective ways to build wealth over the long term, but success rarely comes from chasing quick profits or following the latest trends. Instead, decades of financial research and guidance from organizations such as the U.S. Securities and Exchange Commission, SEC, and the Financial Industry Regulatory Authority, FINRA, consistently point to a few timeless principles. Whether you're a complete beginner or just starting your investing journey, understanding these fundamentals can help you make smarter financial decisions. The first, and perhaps most important principle, is to think in years, not weeks. Stock prices fluctuate daily because of news, economic events, and investor emotions. In the short term, even excellent companies can experience significant declines. However, history has shown that diversified stock markets have generally rewarded patient investors over long periods. Instead of worrying about daily price movements, focus on where your investments could be 5, 10, or even 20 years from now. Another key principle is to invest consistently rather than trying to predict the perfect time to buy. Many successful investors use a strategy called dollar cost averaging, where they invest a fixed amount of money at regular intervals, such as every month. This approach allows you to buy more shares when prices are lower and fewer shares when prices are higher, reducing the emotional stress of trying to time the market. Diversification is another cornerstone of successful investing. Putting all your money into a single company or industry can expose you to unnecessary risk. Instead, spreading your investments across hundreds or even thousands of companies through broad market index funds or exchange-traded funds, ETFs, helps reduce the impact of any single company's poor performance. Diversification doesn't eliminate risk, but it significantly lowers the chance that one bad investment will severely damage your portfolio. Keeping investment costs low is equally important. Every dollar paid in fees is a dollar that no longer has the opportunity to grow through compounding. Even seemingly small annual fees can reduce your long-term returns substantially over decades. This is one reason why many financial professionals recommend low-cost index funds for long-term investors. It's also important to ignore short-term market noise. Financial headlines often focus on dramatic market crashes or sudden rallies because they attract attention. However, market ups and downs are a normal part of investing. Selling in fear during market declines can lock in losses, while staying invested through periods of volatility has historically rewarded patient investors over the long run. Although past performance never guarantees future results, history shows that markets have recovered from many downturns over time. One of the most powerful concepts in investing is compound growth. Compounding means your investment returns begin generating returns of their own. For example, if an investment grows by 10%, future gains are earned on the larger balance rather than just the original amount invested. Over decades, this compounding effect can become one of the biggest drivers of wealth creation. Many beginners believe they can consistently time the market by buying at the lowest prices and selling at the highest. In reality, research has shown that even professional fund managers often struggle to do this consistently. Missing just a handful of the market's strongest days can significantly reduce long-term returns. For most investors, remaining consistently invested is generally a more reliable strategy than attempting to predict short-term market movements. If you choose to invest in individual companies, make sure you understand the business before buying. Learn how the company earns money, whether it is profitable, how much debt it carries, and whether it has a lasting competitive advantage. Investing in businesses you understand is usually less risky than chasing companies simply because they're popular on social media. Risk management is another essential principle. Never invest money that you may need in the near future, such as emergency savings, rent, or monthly living expenses. Stock markets can decline unexpectedly, and being forced to sell investments during a downturn can result in unnecessary losses. Finally, remember that successful investing is as much about controlling your emotions as it is about choosing investments. Fear and greed often lead people to buy after prices have already surged and sell after prices have fallen. A disciplined investment plan combined with patience and consistency is often far more effective than reacting emotionally to every market headline. In the end, building wealth through investing is usually a marathon rather than a sprint. By thinking long-term, investing consistently, diversifying their portfolio, keeping costs low, avoiding emotional decisions, and allowing compound growth to work over time, you give yourself the best chance of achieving lasting financial success. While no investment strategy can eliminate risk or guarantee profits, these principles have remained among the most reliable foundations for long-term investing.